Now, Fatih, overnight we had President Trump imposing tariffs on solar panels. What do you make of that move? What implications are there?
I mean, the trade disputes among the countries are not uncommon. We see it all the time. It's not the first time, it's not the last time. When you look at the solar generally in the world, we have seen an excellent trend. For example, last year, when we look at the entire world and all the new power plants installed, more than half of it was solar. The other half, everything else put together. And this is mainly because the cost of solar is going down. So as a result of this new measure by the US administration, we may well see implications on the US solar trends. But I am sure that the US industry and the others will adjust to that, perhaps not immediately, but in a certain period of time. And I am expecting that the US government will help this adjustment to the new context. And I am certain that the US solar push will continue in the next years to come after this blip.
But having said that, is there a way of quantifying the impact on demand?
I think it will be difficult to have an exact quantification, but I wouldn't think that this would, for example, crash the solar push in the United States. It may have an impact in the next few months, perhaps a year or so, but later on, I'm sure the industry will adjust because anyways, the solar costs are going down and we will see more and more solar installed in the United States as well.
The meeting here in Davos is expected to focus a lot on electric vehicles as well as energy transition. But when you take a look at demand for oil, it shows the opposite story. Has there been a lot more hype?
Yeah, it is. In fact, last year it was the same thing. The electric car sales was at record numbers, and many people talk, even oil companies, that we are going to see a peak of oil demand and it's going to go down. And at that time, I was saying we don't subscribe to that for very simple reasons. First of all, today only 25% of the oil demand comes from cars, private cars. 75% from other things like trucks, jets, petrochemical industry, ships. The cars themselves only 25%. And last year we had record electric car sales. This is true. But what does it mean? It means 1 out of 100 cars sold was electric cars. 99 cars were the traditional internal combustion engines. So I asked my colleagues to calculate the following. Not 1 out of 100, but if every second car, so 50 out of 100, was electric cars sold, are we going to see a peak oil demand? The answer is absolutely not. The reason is oil demand growth is driven by trucks, by jets, and mainly petrochemical industry. So these are the blind spots of the oil demand growth. And I think it is important for the oil markets, manufacturing industry, the investors to see, not only focus on the electric car sales, but to understand the oil markets, they need a more holistic view.
Now, you revised up your projection for U.S. shale production. Would that limit price increases? And having said that as well, what implications are there?
I mean, we are, when we look at the U.S. oil and gas numbers, we see that from a strategic point of view, U.S. is set to become undisputed leader of oil and gas markets for many years to come. So in terms of natural gas, as a result of shale gas revolution, U.S. is #1 gas producer of the world today. And we expect this year or next year, U.S. will be the #1 oil producer of the world. So what does it mean? It means we have oil prices close to $70 as a result of the certain measures that the oil-producing countries, exporting countries, took together and implemented in a successful way. But $70 means giving additional incentive to U.S. shale oil to increase. So what will happen now, the game is a bit different than a few years ago, before the shale times. Namely, if the prices increase, this will give a more stronger incentive to U.S. shale oil production growth, and this will come to the markets in big volumes, and this will bring the prices down, push the prices down. So what we are going to see is there will be much more volatility in the oil prices as a result of the traditional established exporters pushing the prices up, U.S. shale oil benefiting from that, increasing the production, and pushes the prices down, and more volatility.
So fair to say that you expect U.S. production to surprise on the upside. That will continue?
Yes, we are revising the U.S. shale numbers regularly in our estimations, and most of the time, if not all, on the upward revisions they are. So when I look at this year, I see two potential surprises in our numbers that we may revise. One of them is upward revision of U.S. shale as a result of prices and more incentive, and maybe even further downward revision of Venezuela, and as the production is going down there significantly. In the very short period of time, we have seen Venezuelan production decline about 500,000 barrels per day, which is historical. So when you look at the times of, for example, Mr. Chavez coming to power in 1999, compared to that time and today, the Venezuelan oil production is halved. It is unprecedented. And when we look at the situation in Venezuela today, I can tell you that no risks, no activity, no financing, and we may well need to revise Venezuelan production downwards. So when I look at this year, I see upward surprise potential from US and downward revision potential from Venezuela.
Is there any possible surprise that the market has not factored in yet?
Well, this is the beauty of the oil market. So there are many surprises, but this year, when I look at 2018 for oil markets and beyond, I see the political risks and the surprises may be much more important than the economic risks and the surprises.
Now, talking about stockpiles, part of the reason for the strength in oil prices is the declining stockpiles in the US, but there is little clarity when it comes to stockpiles within OPEC member countries, especially the developing nations. What's your take on that? What assumptions are you making?
So it is one of the areas that IEA is working very hard to understand the stocks, where are they going, because not every country is providing transparent numbers in that respect. But in general, we see that 2018, this year, will be more of a year of balanced markets, and we do not expect a big erosion or a big build-up of the stocks.